Kroger is a stock I like a lot right now. And yes, it's true, this is not a tech stock. I love tech stocks. I cover them on this channel all the time. I got my degree in tech. So don't get me wrong, I love tech. However, there's plenty of room for value stocks to fit into a portfolio. And I think this is one of the better ones for quite a few reasons. One is the performance over the last 5 years, up 106%. And then you got that dividend as well. And we're going to look back in this video at the performance of Kroger over a 10 to 15 year time frame, and it's actually very impressive. This is a company that has done well, and I think is primed to continue to do well, or at the very least, it is a good diversification for if there was a recession, you get that decent dividend, and your value, your PE is only 15.5 compared to the S&P 500, which is at about 30 right now. So there's a lot of value in Kroger, in my opinion, and we're going to dive into all that in this video. Of course, when investing in a company, it's important to actually understand what the company does. Luckily for us, I don't have to try to explain to you some crazy high-tech semiconductor thing that this company specializes in. Kroger, they're a retail chain. I have to do that in my videos many times. But Kroger, it's really pretty simple. Founded in Ohio, right? So they're kind of in that Midwesty area, although they kind of go down into Georgia and, of course, some other states surrounding it. If you're really curious, you can look up a map. Not going to cover it in this video specifically, but yeah, really simple. You can read this whole thing if you want to. Food and drug retailer. They do all sorts of different stuff. It's really, like I said, not everyone has a Kroger in their area, although I'm assuming most of you watching this video have a basic understanding of what they do. And if not, just picture a retailer. I mentioned how we're going to be looking at Kroger's total performance. And this is important because dividend makes up a large percentage of Kroger's return. That's just reality. They're over a 2% yield. So if you aren't looking at that, you're just looking at stock price comparison. That's not necessarily fair. So we're comparing Kroger to the S&P 500, just a baseline for the market to see how they have done. And believe it or not, this arbitrary date in 2010, since then they've performed 500%. S&P 500 only about 400%. So this isn't a bad performance. Certainly not. This is actually very good for a number of reasons. We would not expect a stock like this, a value stock typically, a retail stock. This isn't a cutting edge tech stock. We typically don't expect these companies to perform better than the market. They aren't valued to perform better than the market. That's just reality. So when they do, it's really something to take note. And if you bought during any time except for a little bit here, we can see early 2014 to middle 2017. If you bought during any time outside of that, you would have basically been in line or better than the S&P 500 performance. We can just see here it was a bit expensive. Now, I'm not saying it was a terrible buy. I don't have the numbers. I'm not in this situation, so I'm not going to flame anyone for buying at these prices here when it was but it was up 300, 200% in a 5-year time frame, less than 5-year time frame for a retail stock. So I think the bet or the buy you are making is a little bit different than the one you're kind of really looking at now. It's just different. I'm not saying it was bad, but it just didn't come to pass, and it's not necessarily what we're looking at right now. But if you bought during almost any other time frame except maybe this little spike right here, you would be happy with the performance. Like I said, you're right in line. It was a little bit more expensive, a little bit cheaper, but that's not really anything you're worrying about. And going back to the performance, the reason we hold value stocks, I love tech. I own plenty of tech. Majority of my portfolio is in tech. It's going to outperform in the long run. However, in my opinion, it is important to hold some value stocks because, one, when there's a recession and tech stocks are getting slaughtered, I would like some money that I'm able to put in there, zig when the market zags. Not that every company is going to continue to do incredible. I'm sure many companies will do, maybe even go out of business, but there's plenty that won't. When you're looking at a stock price, you see dips and you see rises and you want to buy the dips, but when it's actually dipping, it's scary. But if we're holding value stocks, something like Kroger, it fits a number of categories. One, it has a decent dividend. So if the stock price were to dip dramatically, you're actually getting something from it. Also, it's a business that does fine in a recession. They sell food. They sell drugs. People are going to need food and drugs and clothing during a recession. Unless it's apocalyptic tier. People need all that stuff and they're going to go to the grocery store to get it. This is not a company that's going to do bad. Like I said, there's many stocks, even like Kroger, it'll probably dip. But during a prolonged recession, this is a stock that's going to do better than something like a Vertiv. And I like Vertiv. fine, if that's what you're looking for. But this is a company that is going to do decent during a recession. So it's important to have some diversification here. But also, this is a company that has performed it's outperformed the S&P 500. But even if it were to slightly underperform, that is still a decent bet. And that's what I'm kind of looking forward to with Kroger. So looking here at PE, we can see PE is at 15.5. That's cheap. Also, PE of 13.24 is also cheap. S&P 500 for PE is right around 23, 24. So it's a little bit over half as cheap as the S&P 500 is, which is pretty important. But also, when looking at here, GAAP is definitely a little bit lower than non-GAAP. We can see 14%, 12.5%. Compared to GAAP, you grow 40, and then you're down 3%. So it's a little bit lower on that front, meaning there's probably a little bit of distortion there. However, from what I can see, it's not anything crazy. GAAP is expecting a little bit higher because 4PE is lower. However, non-GAAP, we're expecting to shrink slightly. I actually like this. I like this, and I'll tell you why I like this. Because we're not expecting to grow. We're expecting to shrink a little bit. Now, of course, we want our companies to grow. However, in my opinion, usually it's easier to beat when you're expecting a meh year than when you're expecting a great year already. There's often less disappointment. There's less crazy dips. Of course, they can still miss. They can still miss dramatically. However, at least in my brain, that's how it works. Now, does that really mean that's what's happening? No. But that's what makes sense to me. So I really don't mind this at all. And like I said, this is a company that is valued, not expensive. It's not valued like a company that has to hit a home run, right? And I like growth tech stocks, but plenty of them are priced in. It's like, oh, if you aren't growing 20% year over year, you're gonna depreciate some value there. As we can see here with revenue, 7%, 1.2, and then shrinking. So revenue is not as impressive as earnings per share, but it's also not a terrible thing. And I'll tell you why. I think it's impressive that they're growing earnings per share at this rate, while revenue is not really growing up that much. That tells you that they're being able to invest in areas which have higher profit margins. And that's really, really, really important for retail because there is no profit margin. Of course, I'm exaggerating, but when you look at just how much revenue they do and then how much profit they take in, it is minuscule. And it's minuscule not in this company, it's minuscule across the board. Look at Amazon, their retail side of things. Look at Walmart, look at Target, look at Dollar Tree. It is very, 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 very difficult to make money and grow in this industry. It just is. There's lots of competition. That's probably the biggest negative for Kroger. Like I said, this isn't some cutting edge tech stock we're investing in. This is a stock that has a decent hedge against recession. And all the businesses that do that generally don't have crazy high moats or they don't grow a lot. So I think Kroger is a decent bounce for that, even though, yes, probably the biggest negative is there's a lot of competition in this area. Taking a look at the balance sheet, there's a few things that stick out. Now, please understand, this isn't quite as bad as it looks. It's not a tech stock. It's just not. If you take a look at their peers in retail, something like a Target, you're going to see right in the same range, at least in the sense of, okay, total current assets, you're going to have about as much debt, and liabilities are going to be in that range, maybe a little bit higher. In this case, it is. And we can see there, with debt, it's even just decreasing from 14 to 12.2. That's not concerning. And of course, people haven't been wanting to borrow a whole lot in this time period with rates being high. Of course, they already had a lot of debt in general, but they haven't been increasing it. Now, honestly, you wouldn't probably care to see that increase slightly as well. Now, taking a look at operating income and revenue increasing, we increased revenue a little bit, but we've increased operating income. Well, if you take 2023, we've definitely increased it faster, of course. Like I said, GAAP versus non-GAAP, these numbers aren't 100% accurate. You've had some one-time expenses, but still, going off of this, it's still not a terrible metric. We're increasing, obviously we're not like doubling in a 5-year time frame, things like that. This isn't the tech stock of the year, of the week, whatever. You aren't expecting multiples of profit like 2xing, 2.5xing, 3x. Now, if that happened, we'd be happy about it. But we don't necessarily need to see that. We don't. Of course, you're going to get that dividend. It's going to be a large portion of your growth as well, reinvesting that. This looks fine. Like I said, you're increasing revenue, you're increasing profit. There's nothing crazy here. Maybe you'd like to see the profit margin increase slightly, but it's just such a difficult business to get that up dramatically. So there's nothing really too concerning here. It's not the most optimistic, but we've taken a look at their performance throughout throughout this video earlier in it, and like I mentioned, we aren't necessarily expecting this to outperform the S&P 500. So there's nothing here that I'm really too shocked about. Every company and business has risks, advantages, and disadvantages. It's important to actually discuss them, lay them out, so you kind of have an understanding of, okay, this is a risk I'm taking, this is what I'm buying into, and at least you understand it if worse comes to pass or whatever it may be. Of course, I can't cover every single risk in this video, so if you have any specific ones, you can ask them in the comment section. I would love to address them, at least as much as you can within a comment section, right? But Kroger, of course, they are retail. There is competition in retail. There just is. Walmart, Target, Dollar Tree, whatever it may be. There's plenty of other stores out there. Now, it's not quite as competitive as like the automotive industry, in my opinion, but still, it's a competitive industry. It presses deeper onto, how am I trying to explain this? Margins are already thin. Competition does not help that. That is a reality. Now, of course, as consumers, it's probably not a bad thing that there's quite a lot of different choices. That's good. There's going to be your more expensive, healthier options. There's going to be, hey, Walmart, super cheap. You got your Costco, buy in bulk. It's not a bad thing to have lots of variety, at least for a consumer. But for Kroger, not necessarily working towards their advantage. That's just the reality of it. Another disadvantage, you got that ceiling. You got that cap ceiling, of course, with a tech stock like an AMD. Let's look at an AMD. If they hit it out of the park with their AI stuff over the next couple of years, they're going to make so much money. You're never going to have that with Kroger. You're never going to have a 3, 4, 5x in like a 2 to 3 year period. Although we saw from 2010 to 2016, they did 3x in like a 5-year period. But then after that, reality came crashing down. So it's very, very, very unlikely. Things would have to like stars would align, angels descending from heaven, singing sort of thing to have like a 4 or 5x in like a 4 or 5 year period. It doesn't happen in this specific business. Another disadvantage, like I said, food, what they do, it's just such thin margins. There's so much competition, so much competition, but also the stuff itself, thin margins. You have theft. Theft is a huge cost on margins. It truly is. So there's lots of disadvantage with it, but like I said, advantages. Recession proof in the sense that people need food, people need drugs. When there's a recession, it's the reality of it. Another advantage, they aren't crazy large. I mean, looking at it, $42 billion market cap. That's not small. It's not huge either. I mentioned earlier in the video how there's not Kroger's in my area. There really isn't. There isn't any. Probably many of you watching, there's not in your area, or even just look up a map. So there's room to grow. It's not quite like a Walmart. When you look at Walmart, it's like, yeah, they can keep growing, but they're really going to need to grow that online because you can only open so many more Walmarts in places. There's only so many more, certainly in the United States, maybe overseas, but that's a whole different story. With Kroger, there's still room to grow. If they continue to do well, there's no reason why they couldn't continue to expand quickly. It's not like they've reached their ceiling there. And like I said, they've seemed to find their stride. They really have. They've been growing well the last 10, 15 years. I think I don't know, I disagree with this here, right? Economic moat, none. They're still established enough. When you hear Kroger, you don't think like, they have some brand. They do. It's smaller, but they do. I think none. I just hate the 0, 3, 10 scaling. I've complained about it videos numerous times. So I'd lean more closer to narrow, but I think it does emphasize like, hey, this isn't a crazy large moat. There is competition in this specific area, but like I said, despite all those risks, the advantages, in my opinion, what this stock is priced at and what it has to offer. Now, if this was at 30 PE, my opinion might be a little bit different. If they hadn't performed so well, my opinion might be a little bit different. But I think if you're looking for a retail value stock, this is one of the better ones you can probably find. Now, Schwab kind of agrees with me. They think it's going to perform well over the next year or so. I think it's a 1-year outlook. They usually do. They reiterated that 5 days ago. Top 11 percentile. That is a good rating. They do not give that out all the time. Actually, 89% of stocks have a worse rating. So they kind of agree with what I'm thinking here. I don't even think it's going to necessarily just shoot up, but I just think it's a good opportunity for a long-term investment. Now, of course, it's not financial advice, but like I said, I do think this is a good opportunity. They have a lot of things going right for them. I've mentioned them before, but I'll reiterate them one last time. Good growth, track record, performing near the S&P 500 levels. You're cheap. You're valued well within the value range. Certainly in this market with higher PEs, and you have companies that you would think like Pepsi that are closer to 30 PE. You just see that. You have a good dividend, good performance, and you're a fairly recession-resistant stock. Now, forecasting. I don't like to do that. I'm not a big forecasting guy. I think there's so many variables in the stock market. It's impossible to predict where this price will be in 3 years, 4 years, 5 years. Because even if the company's doing well, sometimes people get down on a stock, get down on an industry, whatever it may be. But that's not the point. I think Kroger will underperform the S&P 500 going forward over a 5 to 10 year time frame. Now, that doesn't mean I don't think it's a good hold. I think it's a good buy and hold. Personally, for me, I'm doing it. I own Kroger. I like it. I do. I'm willing to take that downside with some, like I said, some hedge. This is a stock that's going to return decently well. There's not going to be a lot of companies you can find near 15 PE that I think are going to return near the S&P 500, give you that solid dividend, give you that, like I said, recession resistance, not proof, but resistance, where it's going to hold up well during an extended time period. People like to pour their money from tech into value stocks during a recession. Of course, maybe it's not enough to make it higher, but that's just the reality of the situation, in my opinion. We'll see how that actually goes down. But like I said, I think Kroger will underperform the S&P 500 over a 5 to 10 year time frame. However, if you're looking for a value stock and you don't mind that, could be a good opportunity. I do think so. I think it's going, like I said, I think it's going to be tough to find some that perform better than this. Now, of course, I could have dove in a couple of other topics. Historical PE I didn't quite touch on deeply. Their historical PE is kind of right within that range. They kind of bounce between 10 to 15 to 16. Obviously, we're at 15, but this is a market that has higher PEs than you normally ever see. So, excuse me, but we're wrapping up here. If you guys enjoyed, appreciate if you like or subscribe. I do daily stock content on this channel. I know most of you are regular viewers or subscribers, and I appreciate all of you, especially for making it this deep into a video. It means a lot that you guys enjoy and watch my content and like and leave all the nice comments and stuff. So I appreciate all of you for watching, and I'll catch you next time.